Good morning and welcome to another edition of MasterMind Minutes. My name's Gary Occhiogrosso. I am the managing partner for Franchise Growth Solutions. That's this big sign in back of me. And if you want to learn more about what we do with Franchise Growth Solutions, you can just click on the link above or below the webcast, and that will take you to our website and you can learn all about it. MasterMind Minutes is the program where we have one guest and one topic, and we answer a question expertly in minutes, not hours. And we realize that that may be a tease. So at the end of the program, we will give you the contact information for our guest if you want to reach out. And our guest today is a gentleman that I first became aware of in, I'm going to say, probably the 1990s, when I had read an article that he had written about Boston chicken, Boston market, Boston chicken at the time. And then had the pleasure to actually meet him and become friends with him a few years ago. And he's just a wealth of information. So I want to introduce you to Roger Lipton. And Roger is an investment professional with over 4 decades of experience specializing in chain restaurants and retailers, as well as macroeconomic and monetary developments. After earning a BSME from Rensselaer Polytechnic Institute, and an MBA from Harvard, he began working as an auditor for Waterhouse, and it was at that time where he started following the restaurant industry. Roger is truly uniquely equipped as an investor, a board member, an advisor, especially related to the restaurant, franchising, and retail industries. He has studied great success stories such as McDonald's and Shake Shack, but even more importantly, and we're going to touch on it today, he has watched scores of companies stumble and fall. So Roger, I don't want to end on the negative note there on your bio, but welcome and thank you so much for being with us today. I truly appreciate it.
Oh, it's fun, Gary. Always nice to see you. And you and I never have a shortage of things to talk about.
No, I know. If we got paid by the word, boy, would we be in good shape.
Right.
I see you're back in Manhattan, so tell us what's going on.
Well, the people that are returned to Manhattan because the schools are at least partly open for the moment. The offices are still not occupied. People are apparently working from home. I'm in the office. I come into the office several days a week, work from home 1 or 2 days a week. But I get more work done in the office. It's just more efficient, fewer distractions. The last thing I need is my wife looking over my shoulder all day long.
I hear you.
Yeah. But I can do, I can stay in touch with the people I need to stay in touch with now, and we're getting a little closer to the end of the tunnel. For a number of months, as you know, I have a website that I publish on a couple times a week at least. I try to get 2 or 3 articles written on my website, which is rogerlipton.com, as you know, So I like to commentate on the industry, but it was very difficult for from March through June, July, because we didn't know what the companies look like. As you know, I'm primarily investment oriented, investment banking oriented, and my role when I advise companies is often from a financial standpoint. But we didn't know what all the publicly held companies looked like. We didn't know what the balance sheets looked like. We didn't know how the sales were. We didn't know what the margins were, but now things are starting to become a little clearer as publicly held companies report their June results and now their September results. We can see what their margins are. We can see how their sales are doing. We can see who has emerged stronger or weaker from the pandemic. We're not through the pandemic, but we start to see the light at the end of the tunnel. Yep. And we can make some. So I'm writing again more actively about the individual companies.
Well, that's good. And the reason, why there's a lot of reasons why I wanted you on the program, but kind of the catalyst was an article that you had recently written about investing in franchise companies with what we've learned in the pandemic. And maybe you want to talk a little bit about how the environment has changed, either if you want to become a franchisee or if you're an investor. Like I'm invested in certain franchise companies, certain restaurant companies. Quite honestly, I don't know how the pandemic is going to change my investment approach. I do know that as an operator and as a restaurateur and a franchisor, we've embraced a lot of the technology that already existed, but we weren't using, like third-party ordering platforms and things of that nature. However, those things impact the bottom line, which
Right.
obviously impacts the performance of the company. So, what thoughts can you give us on that? What should we be looking for?
Well, I think you never know. Things are changing daily, almost in terms of various states closing back down again and trying to reopen, but California is a shelter in place now for the next few weeks, and Governor Cuomo is here in New York is threatening to close indoor dining again within the next week or two, which is going to be painful. I think, however, it's clear that big box restaurant operators are going to have a hard time.
Mhm.
I think the public. I believe that the economy, no matter what the politicians say, the economy is going to continue to be in tough shape. I don't think any individual consumer is feeling a lot better coming out of the pandemic than just financially than they were going in. I think they've been scared. I think this has been traumatic for most people. Just as it took our parents a long time to recover from the depression. They came out of the depression very conservative, very risk averse. And I think you're going to have the same kind of thing here. I think forget about a V-shaped recovery. I mean, the politicians like to talk about it. They're talking already about the strong growth in the third quarter and the fourth quarter, and versus March, it's strong growth. Versus April and May, it's still strong growth. The numbers are going to look pretty good year to year over the next 6 or 9 months, year to year. But when are we going to get back to sales levels and profit margins that we had in 2019? I think it's indeterminate, especially for the large box guys who have to figure out how to merge off-premise and on-premise, right? Because you have now they got to do both, right? From Darden to Cheesecake to BJ's and all the other kind of larger Chili's, Bloomin' Brands, Outback Steakhouse, and so forth. They've learned that they can do more off-premise, curbside pickup and delivery, right? To mesh with their on-site, which is still restricted in terms of how many seats are allowed, right? I mean, even when they allow 100% a dine-in, the social distancing cuts that back to closer to 50%, right?
Yeah.
So for Cheesecake or Darden or the others to do the same volume now or in the near future that they did 2 years ago, they're going to have to do 20 or 30, 40% of their business off premise, and then do whatever they can on premise. And so the best guys, the real strong larger box guys like Darden and Cheesecake, they're going to survive. They've got great balance sheets, and they're going to survive, and they serve good food for the price, right? People have to eat. But the secondary larger box operations, like for instance, Red Robin or other names would come to me if I looked at my entire list, right? Mm-hmm. They're going to have a problem. They're going to have a real problem because they don't have the balance sheets to support what they need to do, and so forth. Which leads us to small box operators. It's very clear that Wingstop and Domino's and Papa John's, 2 of the 3 happen to do pizza, have come through stronger. Clearly have come through the pandemic stronger than they went in. Their same-store sales are up double-digit year to year. Their margins are up. Their franchisees are happy. Wingstop franchisees were already happy. Papa John's franchisees are happy again because they got some new management as well as the benefit of the delivery-driven pandemic, right? And Domino's, of course, has been strong going in. They're going to be at least as strong coming out the pandemic. So, but still, the smaller size operators are going to be the best equipped with if they can deliver and pick up, and customers pick up, of course, and so
Right.
forth.
So Roger, with that kind of as almost like a pre-frame, and thank you, because it's interesting how you and I agree. There's the big box folks who, the Cheesecake Factories of the world, who can survive. Then there's that second tier, the Red Robins, the Bennigans. I don't even know if they're around anymore, but
Right.
that level.
Right.
And then, what you're referring to is the small box users, who are either the fast casuals or the quick casuals, and not necessarily restaurants that are in huge locations or drive-through, freestanding drive-throughs. They're more of those storefront operations where the nature of their business is out the door. I guess what I want to ask with relationship to that is, because there's really two pieces here. I can be a passive investor and buy stock in those companies, or I can be more of an active sort of entrepreneurial investor and want to buy a franchise in one of those companies. And if I'm hearing you, what I'm hearing is perhaps if I'm looking to buy or open a franchise, I probably want to go more towards that small box user, which might not be as glamorous, by the way, but it seems like those units are in a better position to kind of be nimble and kind of weather whatever is going on. Am I hearing you correctly?
Yeah, no, I think so. The question is, the challenge is how to find them. I mean, you can't get a Domino's franchise, I don't think,
Yep.
or even Papa John's and Wingstop. Most of they're building 120 stores a year at Wingstop, but almost all of them are being built by their existing franchise system. So the obviously successful, well-established small box guys, it's gonna be hard to get to be part of that system. If I were a little younger and wanted to get involved again, and I've been a franchisee a couple of times in the last 40 years, and it didn't work out either time. For I like to say that every 20 years I blow my brains out as a franchisee, right? Well, 20 years is up, but I don't have another 20 years to spend. I hope to have 20 years, but I don't want to spend it dealing as an operator,
Right.
But if I were a little younger, I try to find some Domino's territory, or I try to find a few Domino's stores or Papa John stores that aren't so well run. So clearly, where the original franchisees get a little tired, right? And maybe I'd go in and run the stores better. I'd kind of try to be opportunistic that way.
Well, let me just jump in and ask you a quick question on that. So do you think there's value in perhaps paying a bit of a premium of the COVID price in buying up operating units of those small box users, even if they're not? I mean, if they're poorly run and you feel you can turn them around, great. There's not a lot to think about there for me because I'm an operator. But you think there's upside value in picking up and maybe paying a premium in buying some existing small box operations?
Yeah, a premium, of course, is in the eye of the beholder. Naturally, you don't want to pay top dollar ever for anything in life, but if you happen to find some Domino's stores that aren't particularly well run, or the family that's been in the business for 20 years wants out, you make a deal, best deal you can, because the Domino's is going to be around. Well, what a lot of potential franchisees don't realize is the franchisor you sign up with is crucial, because you're marrying that system for 20 years, and you got to hope they support their franchisees well, that they're going to be around, that they've got respect in the financial community so stores can get financed, right? And so I was a franchisee of a second-rate chain. I don't even want to mention it because it's a whole other subject, but I remember I built a couple of stores, and I went out to a conference where all these lenders had their booths, and all the money in the world, and it always reminds me. I go to this conference. It's run by John Hamburger, a restaurant finance monitor, right? We've been there every year in Las Vegas.
Every year in Las Vegas.
Not this past year, but I remember going out there 10 years ago when I built a few stores with my own money, and so the stores were up and running, and I figured, well, go out there. You got all these guys lined up with their booths, who want to give money to franchisees, right? So I went, I told them what I was doing, and they said, well, yeah, sure, we would finance it, of course, with your personal guarantee. I said, personal guarantee? The stores are built, if I need to give you my personal guarantee, I might as well just sit with my money invested. But that's not the object of the game, So it reminds me of the old Larry Gatlin country western tune, "All the Gold in California," and I won't sing it for you, but it goes, "All the gold in California is in a bank in the middle of Beverly Hills in somebody else's name," So they'll give you, my father always taught me, the banks will give you all the money you need when you don't need it. And if you really need it, they don't want any part of you, So the point is, I guess the point is, you got to be careful. You got to be careful because you're signing up. And I signed up twice with weak franchise systems, and that undermined me, and that cost me a lot of money.
Yep.
So you could be a mediocre operator in a strong system, and have a mediocre location and still survive, right? You could be a good operator, as I was, in a weak system, and it just was too costly, and I ended up losing a lot of money.
So,
right? So you got
what should we, if I wanted to be an entrepreneurial investor in a small box franchise, which we've kind of narrowed, funneling this down now, what are some of the things that I would want to look at in general, and then perhaps with more of a focus, given what we've learned here in the pandemic, to get back to your article on what we've learned. So, entrepreneurial investor wants to get involved in a small box franchise. What are the key elements that I should be looking for?
Well, look, obviously, the key element is, as you and I've discussed many times, is, the rubber meets the road with the unit level economics.
Yeah.
That is the, and also are the profit margins strong enough to be able to afford the royalty structure? Because, a lot of companies, they advertise the profits in the company stores, but the profits in the company stores are prior to the 4 or 5% royalty, and prior to 2 or 3 or 4% advertising fees, and prior to local G&A, local administrative, right? That small franchisee with 1 or 2 or 3 stores, he's got to have an office, he's got to have a bookkeeper, he's got, he's got to have a car, somebody's driving around in a car supervising, right? And so therefore that's, it could be 2 or 3 or 4% of your sales, right? So say that the company advertises 15% store level cash flow, and right, that's before royalty though, right? 15% sounds good. 15% on $1 million store, right? And it costs you $500,000, $600,000 to open that $1 million sandwich shop, right? And right, and so 15%, the company stores, right? But that's before the 7, 8, 9% of fees, right? Which only leaves you 5 or 6%. Before local G&A. G&A is going to be 2 or 3 points. Now you're less with 3 points. 3 points of $1 million is $30,000. $30,000 bottom line cash return is not much of a return for your time and money on your $500,000 or $600,000 investment. So linear level economics are important, but you've got to talk to some franchisees. I would hope that somebody will read the franchise disclosure document, which talks about a lot of stuff. Got to talk to some operating franchisees face to face, and you got to really try to see their numbers. Got to get a copy of their numbers, the franchisees' numbers. Now, you're going to have to push. It's not always pleasant. You feel like you're intruding, and you don't want to be too negative, because after all, you want to buy the franchise. You kind of like the operation, right? It's a courtship, right? You don't want to be too. It's like talking to your fiance about a prenup, right? You don't want to remove the romance from a relationship, right? So you and the franchisor, you're courting each other, right? And now you want to see the numbers, and now you want to bring in your lawyer to talk about the franchise agreement, right? But you don't want to, as I say, take the romance out of the relationship. But you have to, because you're going to be married to that franchisor for the next 20 years.
Yeah.
And yeah, maybe that's why you have to have an advisor, Gary Occhiograsso or Roger Lipton or somebody else to be your middleman, right? You say, wear the black hat. Say, look, I'm been hired here to do some homework for my client. And I know, nobody wants to pay consultants. I understand, but 5 or 10 grand you pay some consultant could be the cheapest money you ever spent.
I agree. I will tell you, to your last point with respect to unit economics, when, one of the things that my company does in addition to actually expand and have a franchise sales organization, we actually do franchise development, where we take individuals who might have 1 or 2 or 3 restaurants who want to franchise that concept, and we'll go in and we'll do that work. Well, one of the first things we do before we even take the client on is we do a full P&L review, and what we look for is precisely what you just spoke about. We look for, what does that bottom line look like once all those fees are rolled in? Right. And we won't take a client on unless we feel that we can bring some intelligence to the table, where if I know we're going to add back a 5% royalty and a 2% brand development fund and a 1% advertising fund, call it 7, 8 points, whatever the numbers are, 8, 9 points, I need to find that somewhere else in the P&L by helping the franchisor either create systems that reduce labor that they can pass on to their franchisees, or show them how to do value engineering on their menus so that they use higher profitable items or higher in the P mix. Either way, if the franchisee is not going to pull, at least our minimum benchmark is 15 points. If they can't pull 15 points to the bottom line after franchisor fees, we're not interested in the concept, because as a restaurant model it might work, but as a franchise model it won't work.
Exactly. There are a lot of restaurant guys. They open 1 or 2 stores that are doing okay, and they think they're going to become they think they're the next McDonald's. Years ago I ran into a guy with a pizza shop. It was a pizza by the slice operation here in Manhattan, in the downtown plaza, downstairs plaza in an office building, and he was making a good living, this guy, and he found me. He wants to, the guy's one store, and he thinks he's going to be Pizza Hut, And I said, well, before you try to start to create a franchise document, maybe you ought to open your second store, on the street, on the street in Manhattan, before you decide what you're going to do next, right? And so yeah, there are a lot of people, and franchising requires a whole different mentality than running your own shop, right? Because you're partners. Lots of franchise owners don't understand that they are becoming a true partner with their franchisees, and therefore franchising is a completely separate business than running company stores, and I didn't appreciate that years ago.
Yeah.
Until I learned it. And completely, it's a separate business. And sometimes a pure franchisor like a Wingstop or is we used to think, well, gee, unless you can run a lot of company stores, how can you direct your franchise system? You got to be able to do both, right? Not necessarily so. When you're a pure franchisor, you got to know how a restaurant operates. You got to understand your systems. You got to be able to develop new products somehow. Maybe you have 1 or 2 test stores, that you run and so forth. You have a training center, right? But when you're a pure franchise system, and your livelihood depends upon the success of your franchisees, and that's all. I mean, that's your priority.
I couldn't agree with you more, Roger. Again, just to jump in, I mean, when we speak to potential franchisors and we start to look at what their goals are and what their business plan is, if we see that they want to continue going down the road of opening up corporate stores, once again, we beg off. I mean, my thought is 1, 2, 3 stores. If you've proven out the model and you have a training store and a place you can test, that's it. But when you start to build corporate stores, 2 things happen. Number one, and I learned this from a very wise man years ago, as a franchisor, you can't serve 2 masters. You need to serve your franchisee. The other piece is that your you're setting up almost this environment where the franchisees now may feel, oh well, the franchisor is taking all the great locations and leaving the crumbs for us, or
Right.
the franchisor spends more time and money on their own restaurants than they do helping us make money, and it's
Right.
just a conflict. I don't want to use the term conflict of interest in the legal sense, but philosophically, the franchisor is in the wrong place if they're
Right.
focused
Right.
on
Well,
corporate.
especially in hard times, right? Say you go into a pandemic, right? And you got company stores, and you got franchise stores. Well, your company stores, you got all that operating leverage, right? You know, the margins can go from 20% to 10% overnight, right? If your sales go down 10%, right? The franchisees' sales go down 10%. That only cuts your royalties by 10%, right? So,
Right.
so it's natural. Where does your effort? Where do your top operating guys go first? Right? They go to where your real exposure is in the company stores, especially in hard times. Well, anyway, so that's a an important part of it. And
So from
you know,
from the
talk to,
pandemic point of view, just if you could kind of leave us with your kind of your last thought here, coming out of the pandemic, because look, we're not going to be where we are forever. We never
right,
are,
right,
regardless of pandemic. But coming out of this, as I see, it's early December now. Actually, today they just started injecting people in the UK, and I
right,
think there's going to be some real significant improvement in the actual COVID numbers, as well as significant improvement in the, I guess, the feel-good aspect of the general public.
right,
Um, that being said, right now I see lots of opportunity with second generation restaurant space, cheap money, really
right,
cheap money
right,
available,
right,
more flexible landlords. It's not going to last forever. So as we
right.
come out of this, what are you predicting in
I'm
time?
I'm glad you set me up to end on a positive note,
Good.
because yeah, because I think there is definitely there's light at the end of the tunnel in terms of the pandemic, and I do think that while lots of people are disillusioned with the restaurant industry, there's going to be fewer restaurants operating. I mean, I read just today, I think I read 10,000 restaurants are going to close
Yeah.
around the country in the next 2 months, right? I think in today's Wall Street Journal. And so for guys who know how to run restaurants, there's going to be more space available. Even existing restaurants that are equipped that can be refurbished a lot cheaper than building a new restaurant. And so for people that like the business, people have to eat, and nobody wants to cook at home. I mean, so they're going to be looking for places to have prepared meals prepared away from home. Let's put it that way in a real general sense. Meals prepared away from home. There's going to be continued demand for it, one way, shape, or form. So I think for people that like people, like to serve people, like to it's a demanding industry. It always has been. It always will be. But I think there's going to be a place, and I think there's going to be opportunities. We're going to have a whole new raft of companies there are companies out there kind of incubating that we've never heard of. I mean, there's a little chain in Florida called Huey Magoo's,
Oh,
out of
like
Fort
Huey,
Lauderdale.
I worked with Andy Howard over at
Yeah,
Ranch One for
exactly.
many years. I
I was
love
going to say,
Andy.
yeah. So our friend Andy Howard, he was one of the top guys at Wingstop,
Yeah.
and this Huey Magoo's they've opened. I think they got 15 stores operating now. Right in the middle of the pandemic, they're opening stores. I think they opened in Atlanta very successfully, and chicken tenders. Chicken
Yeah.
tenders. It's sort of
Huey
a small
McBooth.
scale.
It's a great concept,
You
and
know,
Andy, and listen, Andy knows what he's doing.
right, exactly. And then we and I have no acts with Andy, or but we can put a good word in for him.
I
But
love him.
because so far so good with that. That's a sort of a small scale version of this thing called Raising Cane's,
Yep.
which is a 3,000 square foot box doing $4 million a year or something. But you can't get a Raising Cane's franchise.
Yeah.
So, and plus it's again a little larger scale box, and I'm not sure you can count on doing that much business with chicken tenders forever. But so in any event, there are incubating concepts out there, and you got to look around for them, and or maybe you can find a rundown version of let's say a Domino's somewhere. But there's going to be opportunities. You know, just have to be. You know, this is America, U.S. of A. It's not socialist. It's not, we haven't gone completely socialist yet, and there's still more opportunity here than anywhere else in the world. Greatest country in the history of the planet, and you can, if you're prepared to work, you can do well.
I agree. I couldn't. That's such a great way to end this. I couldn't agree more. You know, it's just, that's how I view it. I look at the positive aspects of it and the opportunities, which I tell folks all the time. There are always opportunities. They may look different from time to time, but there are always opportunities.
Right. And as you say, interest rates are going to be low forever.
Yes.
We can't afford to pay higher interest rates on the $28 trillion of debt. So interest rates are going to stay low. Money's going to be available one way or another. And you have to have your heart in it and be prepared to work. But it can be done.
It's there. So Roger, if someone wants to get in touch with you, what's the best way? And remember, we'll kind of post all this information on the podcast and webcast, but just let us know.
Yeah. Well, the simplest way, I mean, I'm in New York. I have an office in New York, and you can find me in the phone book. But RogerLipton.com. My website is www.rogerlipton.com, and it's an interactive website, so you can drop me a note through that if you have anything you'd like to talk about, and you know, I'll talk to anybody. You know, a little bit of talk is cheap. You know, you want to do more, we'll have to negotiate. But at least to find out what you're doing and what you'd like to do, I'm happy to talk to you. So just contact me through my website. And you know, I like the business, and so it's fun. I got to get up and go somewhere. So I want to talk to people. That's why I publish my website so frequently to keep. That's my platform for staying in touch with the industry.
Yeah, I hear you. Well, Roger, listen, you're the best. I loved having you on here today. I hope to see you in person for a coffee or a drink or something soon. You know, stay well. And again, thank you so much. This has been incredibly insightful at a time where so many people need good information from somebody like yourself who really has no axe to grind. So thank you so much.
My pleasure, Gary. Talk to you soon.
Bye.
Bye-bye. Bye-bye.